Welcome back to Smart Truths. In today's video, we are going to discuss about conceptual framework and accounting standards. So if you remember, I had done a video about accounting principles where I have specified why accounting principles evolved. In that video, I have also mentioned about accounting standards. So in this video, I'm going to discuss more about accounting standards and also the framework that governs the development of accounting standards. So, how I'm going to go about the topic is for accounting standards, when I discuss other topics about what an asset is or what liability is, so when I discuss all that in the upcoming videos, I will also discuss about the accounting standards that are relevant to that particular concept. So, that's how I'll be taking the accounting standards. So, but to understand accounting standards, it is important that we understand the framework, also known as the conceptual framework. So, this conceptual framework is very important to understand accounting standards. So let's find out what is conceptual framework, why was there a need to develop this conceptual framework and so on. So let's get started. So what is a conceptual framework? So this is a typical definition of what a conceptual framework is. It's a body of objectives and fundamentals where the objectives will identify the goals and purposes of financial reporting, and the fundamentals are the concepts that will help achieve those objectives. So these concepts will provide guidance, that's very important, in selecting transactions, events, and how they should be accounted for, how they should be measured, and how they should be reported or disclosed. So, what we can understand from this definition is it's a framework that is guiding me in selecting various transactions. Once I select the transactions, how they should be recorded, and once I record it, and I should be presenting it or how I should be disclosing it in financial statements, and what is the goal of reporting, what is the purpose of providing a financial statement. All that is given in the form of a guideline. So it's a guideline, it's not a standard. So it's just a guideline, also known as a framework, that is acting as a guide to tell you what are all the transactions you need to record and how you need to record and present it. So this is the definition of a conceptual framework. Then what is an accounting standard then? So in the previous video, we have discussed about accounting principle, like the accrual accounting principle or the going concern assumption. So all these are principles that are used in preparing financial statements. However, accounting standards will specify what are all the accruals that need to be made, how financial statements should be prepared, and what additional disclosures are to be made. So it provides more in-depth analysis about what should be accrued for, how they should be accrued. So that's the difference between an accounting principle and an accounting standard. So we've understood the definition of conceptual framework and what an accounting standard is. But why was there a need for a framework? So it all started in the early 20th centuries, where the accounting theories were developed by scholars. So in early 20th centuries, we did not have a framework, and everybody had their own theory of accounting. But however, it also discussed the main questions about what is the purpose of reporting, what perspective a financial statement should be prepared, whether it should be prepared from the perspective of the owner or whether it should be prepared from the perspective of the entity. All those questions were also discussed by the scholars. Then why was there a need to develop a framework? So even though there were accounting theories that was there before the framework was developed, everything was different. So the theory that was given by one scholar was different from the theories that were given by the other scholars. So what was missing in that was uniformity and diversity. So there was no uniformity or consistency in the theories that were given by them. So to achieve this, and also after the stock market crash where investors started to lose confidence on the companies, there was a need to develop a framework or a guideline based on which a standard should be developed so that it is consistent and companies will follow the same approach and not different approaches. So that is where the need for framework started to develop in the late 1930s. So this we have discussed in the accounting principle video, but I'm again revisiting it so that we understand why there was a need for this conceptual framework. But assuming there was no framework, we just followed all the different theories that was given to us, what will happen is every company and every corporation will be following their own way of accounting. So this leads to judgments that are based on personal beliefs. So when it goes based on personal belief, what happens? It becomes more biased. So what one person's perspective would be different from the other person's perspective. So there will be differences in judgments, and there will also not be any consistency in any issue. So one time an issue crops up, there will be a personal belief that will be interfering and not a particular framework. So there will be a lack of consistency. So this will lead to different issues and also different problems, and it is also going to be haywire. So when everybody follows a different concept, so that is why you need some framework. So you need a guideline to follow, based on which some standards will be developed, and those standards will be consistently applied across all the companies. So it's extremely important so that it becomes more comparable and it is also more understandable. So even the investors or the stakeholders need not find it difficult to understand and comprehend the financial information that is being given by the company, because across the company it becomes comparable when they follow a same set of framework or a same set of a guideline. Okay, so that is why framework is said to be very, very important. So, how did this framework evolve? So, as I mentioned earlier, 1930s there was a stock market crash and investors' confidence had gone down. So, after that stock market crash, we had the Securities and Exchange Commission coming in to put a framework in place, and then it delegated the responsibility to the Committee of Accounting Procedures, which then later designated and delegated it to the Accounting Principles Board. And after Accounting Principles Board came in the Financial Accounting Standard Board, which is in the US, which gave the conceptual framework. So the conceptual framework that was given by FASB looks like this. So it actually provided level 1, which is what is the objective of financial reporting. Why should you prepare a financial statement? Then it provided what are all the characteristics that a financial statement should have, and then it provided what are all the various elements. What is an asset, what is a liability, what is an equity. So it actually provided what are all the various elements, and then it also provided the assumptions that should be used in preparing the financial statements. So this was the conceptual framework that was given by FASB, based on which the gap or the generally accepted accounting principles in the US was developed. So similar to this, we have in India, we have the Accounting Standard Board, which develops accounting standards in India, which is also known as the Accounting Standard or AS. And in UK, we have a similar board of Financial Reporting Committee, which also prepares and develops these standards. So based on all this, we can see one thing, that every country now started to have its own standards. Yes, within the country there was a conceptual framework, and within the country the companies followed the same accounting guideline in order to formulate their standards and also prepare financial statements. But if I have to compare companies across different countries, they will be following a different standard. Like India would be following accounting standard and US is going to follow GAAP. So what happens again, there is this problem of uniformity and consistency, and it becomes difficult to compare. So if a company in India had to acquire a company in US or the other way around, it would be difficult to evaluate the company. So one needs to translate the financials into one, according to one particular standard, and then they need to compare. So it becomes very, very difficult. So in order to bridge this problem, we have the International Accounting Standard Board, also known as the IASB. So this IASB develops this standards IFRS. So this IFRS is nothing but single set of understandable, enforceable and globally accepted reporting standards. So they're all globally accepted reporting standards, which means that companies across the globes will start implementing and following these international financial reporting standards, so that there is consistency in adopting accounting standards across companies and across the globe. So this makes it more comparable. This also increases the investment options that are available to companies, and it's also easier to evaluate companies across the globe. It's easier to ascertain your competitors. It's it's also easier to go and acquire your share in a in another stock market. So all becomes very very easy when you have a globally accepted accounting principle. So this IASB has also given a conceptual framework, but it is also given answers to questions like these: how does having a conceptual framework help? So, if you have a conceptual framework, it will provide a foundation based on which different standards can be set. It also provides consistency across the standards and also improves the transparency, and it also increases the quality and accountability. So across companies, if they are going to follow a conceptual framework and standards which are developed based on the conceptual framework, there is going to be consistency and it is also going to be extremely transparent. So conceptual framework will also help in defining what an asset is, what a liability is, how should I measure it. I know that this is an asset, but how should I measure it? So whether I should measure it based on the historical value, or whether I should base it based on the current market value, what should be the measurement basis for it? So all these questions are answered in a conceptual framework. So when the standard setters are developing an accounting standard, they need to keep all these questions in mind and then develop a standard. So when a stakeholder is actually reading a financial statement, they know that this is the concept of asset and this is the concept of liability that the company has implemented in recording it in its financial statements. So it gives that clarity to a stakeholder or an investor who is reading a financial statement, and this definition that when he reads a financial statement of a company will remain the same when he reads financial statement of another company, and then when he also tries to compare. It also gives him a better confidence because he knows that these are the standards which are being authorized and they're also being followed by companies. So this improves the confidence. So when each company follows one accounting principle or standard in the absence of a framework, he will not have that confidence. So it also improves the confidence and it also holds the management accountable. So the management is accountable for following this framework and the standards that are being developed based on these conceptual frameworks. So that's why the conceptual framework holds that amount of importance. So again, why there is a need for a conceptual framework? Therefore, the standard setters will have a guidance in also to select the accounting methods and also what disclosures that needs to be provided. And it will assist the preparers in selecting an accounting policy. So in case there is no standard and I have a particular issue, I don't know how to go about accounting for that particular issue. I have to develop a policy for myself because there is no standard that exists. Then what should be the base on which I should develop that policy for accounting a transaction? That will be based on the conceptual framework, right? And it also provides a better dialogue between the standard setter and stakeholders. So it provides a common vocabulary and understanding. So it provides a common language to communicate. So it also makes it easier. So let's go into briefly about what the conceptual framework is trying to give us. So the very first thing is it talks about what are all the objectives of financial reporting. Why should I do financial reporting? So when I have lenders and investors, they are the primary source of income or money, investing money in a company, right? So if I have to cater to their needs and also to provide financial information to them, it is very very important. So therefore, the first objective of conceptual framework is saying that this objective of financial reporting is to meet the need of primary users of financial statement and also to help them make decisions about the company. So I'm going to give them a financial information that will aid in making decisions. So that is the very first objective of financial reporting. So give a financial statement that is going to help these primary users in making an informed decision about the company. So that's the objective of financial reporting. Next, this financial reporting should be relevant and it should also be faithful. So, what I mean by relevant, it should be useful to the users that you're going to give this financial information to. So, if there is an investor who wants to know about the company's revenue, then the financial information should cater to that need, and it should be relevant to that particular investor, and it should give him information about what is the revenue of the company. So based on which he is going to predict how the revenue growth of the company is going to be, or he can also compare how the revenue of the company's how the revenue of the company for this year is compared to the previous year. So he can either use it for a forward prediction, or he can also use it to get a feedback of how revenue has improved across the previous years. So therefore it should be relevant to the user who is going to get these financial statements, and then it should also be faithful. So it should be free from bias, it should be also neutral, and it should be based on the concept of prudence, that is provide for the expected losses. So therefore these are the qualitative characteristics that financial reporting should aim to provide. Then it also defines what financial statements are. So what is a financial statement? So what comprises financial statements? That is also defined in the framework. And what is a reporting entity? So whether reporting entity is a single entity, or if an entity has a parent and subsidiary, whether parent plus subsidiary is a single entity, all that is defined in the conceptual framework. And it also defines the elements of financial statements. What is an asset? So what is a liability? So when standard setters are developing an accounting standard, say I'm going to develop an accounting standard for asset, I can go based on the definition that is given in the conceptual framework. Similarly, the case with liability. So it talks about what an asset is, what a liability is, and how this should be recognized. When I should recognize an asset, should I recognize everything as an asset, or when should I recognize a particular item as an asset, when should I recognize it as an expense? So it provides a guideline for that, and it also provides a guideline on when it should not be recognized or removed from the financial statement. And then it talks about measurement. So I know that this should be recorded, but what value should I record it? Should I record it at the value that I purchased it 10 years ago, or should I record it at the value that is today? So today if I purchase the asset, what's the value? So what is the value that I should use to measure this particular asset? So it provides a detailed guidance on how to measure the asset. So in case I measure the asset at historical value, that is the value that it was like say 10 years ago, then what should be the subsequent impact? So the value might decrease, the value might increase. Should I show it in my profit and loss account, or should I just ignore it? So all that is depending upon what measurement basis you choose. So that detailed guideline is given in the conceptual framework. Then it also talks about presentation and disclosure. It is important to give a detailed presentation and disclosure about various items to make it more relevant to the users of financial statements. So in case if you have an asset, we will have a schedule called asset schedule that will give details of all the assets that we have purchased, all the assets that we have sold, and different types and classes of assets. So that is important to cater to the needs of the users of financial statements. So that is also important. So these are all the level 2 that talks about elements, how to recognize, how to measure, and how to disclose it. And then we have the last level, which talks about the concepts of capital. So concepts of capital relates to how the profit should be measured in a company. So it talks about financial capital maintenance, where profit will be measured based on the movement of assets. So what is the value of assets at the end of the period, and what is the value of asset at the beginning of the period? So that is recorded in the financial capital maintenance. So the company can either choose this method, or it can also use the physical capital maintenance, wherein the productivity of the company, how much the productivity of the company has improved. So the standard setters can either use this concept or the physical capital maintenance concept. So why is it important? Is because we need to distinguish between capital and profits. So what is part of capital, what is part of profit? So if there is a change in price of asset or liability, whether this change in price is going to impact my capital or whether it's going to impact my profit. So this guideline is provided in the conceptual framework, based on which the standard setters, while developing their accounting standards, can use. So and based on which the companies can also use in preparing their financial statements. So this conceptual framework is very, very important to develop accounting standards. And if you have to understand accounting standards, it is important you understand the guideline that is provided in this conceptual framework. So in all the other upcoming videos, we will discuss in detail what is the accounting standard for a particular concept. So that will give us a better clarity about the accounting standard, and also we will talk about how it is can be linked to the conceptual framework as well. So I'll be discussing about the relevant IFRS standard. So that will give a better hold of the recent accounting standards that are being developed. So I hope this gives a very good clarity about what a conceptual framework is, why was it needed in the first place at all, and in case I don't have framework, what will happen, and what is the importance and what it discusses, what are all the concepts that are discussed in this conceptual framework. So I hope this gives a good clarity around all these topics. So in case if you have any doubts, please feel free to provide in the comments box below. Thank you so much.